Hello, XRP Army, and welcome back to the Crypto Republic, your go-to channel for the latest tonnage updates in digital assets. Before we get started with today's business, make sure to smash that like button, ring that bell, and subscribe to the Crypto Republic, bringing you updates every day at noon and 7 p.m. Eastern Standard Time. Just a reminder, this video is for educational purposes only. This is not financial advice. Always do your own research before making any investment decisions, always. What if the biggest XRP story isn't the price? What if the real story is something much larger, something happening quietly beneath the scenes of global finance? While most investors are watching charts and arguing over short-term price movements, Ripple is doing something entirely different. It's acquiring financial infrastructure, it's integrating with traditional markets, and it's positioning itself at the center of a financial system that is increasingly moving on-chain. From Binance opening access to hundreds of millions of users, to Japan building regulatory framework around crypto ETFs and stablecoins, to Ripple gaining access to institutions that are moving trillions of dollars every year. The question is no longer whether crypto is entering traditional finance. The question is whether traditional finance is gradually becoming crypto. And XRP may be one of the biggest beneficiaries. The crypto market has always had two competing narratives. The first is speculation. The second is infrastructure. Speculation creates headlines. Infrastructure creates lasting value. And today, Ripple appears focused almost entirely on the second category. The latest example comes from Binance. According to recent reports, Binance has unofficially launched 9 XRP ETF products across its ecosystem. Now, whether investors are bullish or bearish on XRP, one fact is difficult to ignore. Binance serves more than 300 million users globally. That represents an enormous expansion of accessibility. For years, one of the biggest barriers to institutional retail adoption has been access. ETFs remove complexity. They create regulated investment vehicles. They allow investors to gain exposure without directly managing crypto wallets or private keys. But here's where it gets interesting. Most people focus on ETFs as investment products. Institutions often view them as gateways, a bridge between traditional portfolios and digital assets. Write that down. That's very important, ladies and gentlemen. And historically, when new investment vehicles increase accessibility, participation often follows. Not immediately, not always dramatically, but structurally. Short-term noise, long-term structure. That distinction matters because price can move up or down tomorrow. Infrastructure takes years to build, and Ripple appears to be building infrastructure. If Binance represents accessibility, ladies and gentlemen, Japan represents legitimacy. Recent developments inside Japan had attracted significant attention from institutional investors. Japan's ruling Liberal Democratic Party has proposed legal frameworks supporting crypto ETFs and stablecoin development. That may sound technical, but the implications are enormous. Why? Because regulation creates certainty, and certainty attracts capital. For years, institutional investors have repeatedly cited regulatory uncertainty as a major barrier to crypto adoption. Japan appears determined to remove that very obstacle. Even more significant is the growing focus on stablecoins operating on the XRP ledger. We're not just talking about cryptocurrency anymore. We're talking about digital versions of traditional currencies, yen-backed stablecoins, dollar-backed stablecoins, euro-denominated stablecoins, Singapore dollar stablecoins, all potentially operating on infrastructure connected to the XRP ledger. Now, this is what most people miss. Stablecoins may become one of the largest use cases in crypto history, not because people want more cryptocurrencies, but because governments, banks, and businesses still operate in fiat currencies. Stablecoins bridge that gap. They combine the stability of traditional money with the speed of blockchain technology. And Ripple is aggressively positioning itself in that space. History, ladies and gentlemen, offers us a powerful lesson. In 1866, the first successful transatlantic telegraph cable connected Europe and North America. Before that cable, communication between continents could take weeks. Afterwards, messages could travel in minutes. Let this sink in, ladies and gentlemen. This is massive. The impact was revolutionary. Financial markets changed forever. Information moved faster. Trade accelerated. Capital became more efficient. The companies controlling communication infrastructure became incredibly valuable. Notice something important? The winners weren't necessarily the people sending messages. The winners were often those who own the network. That's a useful lens for understanding Ripple's strategy today. Ripple isn't simply trying to participate in financial activity. It's trying to become part of the network through which financial activity flows. And that distinction could prove critical. One of Ripple's strongest strategic relationships continues to be SBI Holdings. For years, SBI has been among Ripple's most influential partners in Asia. The scale involved is often overlooked. SBI operates within remittance and financial networks that process enormous transaction volume. We're talking about systems connected to trillions of dollars in annual activity. That matters because utility emerges from usage. The more institutions connected to a network, the more valuable that network potentially becomes. Ripple's vision increasingly appears centered on creating a stablecoin ecosystem supported by the XRP ledger, USDC, RLUSD, future regional stablecoins, cross-border settlements, institutional liquidity, banking integration. These are not speculative concepts. These are infrastructure components, and infrastructure tends to compound over time. The more pieces added to the network, the more useful the network becomes. But the real shift came when Ripple acquired Hidden Road. Today, Hidden Road operates as Ripple Prime, and this development may ultimately become one of the most important institutional milestones in Ripple's history. Why? Because Ripple Prime has gained direct participation access within DTCC infrastructure. For those unfamiliar, the DTCC sits at the center of America's financial plumbing. It processes and settles enormous volumes of security transactions each day and every year. Trillions upon trillions of dollars. This is not a crypto native environment, ladies and gentlemen. This is a traditional Wall Street, the same ecosystem used by major global financial institutions, JP Morgan, Goldman Sachs, HSBC, and now Ripple's infrastructure is connected to that environment. This does not mean XRP suddenly settles every transaction. It doesn't mean overnight transformation, but it does mean Ripple is obtaining something arguably more valuable: access, institutional access, regulated access, infrastructure access. And in finance, access often determines opportunity. Think of this like the railroad expansion of the 19th century. When railroads spread across continents, fortunes weren't created solely by people riding trains. Many fortunes were created by those who owned critical segments of the tracks. The tracks became essential infrastructure. Financial systems operate similarly. Transactions need rails. Payments need rails. Settlement needs rails. Liquidity needs rails. Ripple appears focused on becoming part of those rails, not replacing every existing system overnight, but integrating into them. That is a much more realistic path to adoption, and perhaps a much more powerful one. Ladies and gentlemen, what the DTCC announcement really means. Recently, considerable excitement surrounded the DTCC's move towards extended trading hours. Some investors interpreted this as proof that blockchain settlement was immediately replacing traditional systems. The reality is more nuanced. DTCC's 24/5 trading expansion primarily focused on increased netting cycles and extended operational capabilities. Existing settlement infrastructure remains central. Fedwire remains important. Traditional clearing systems remain important. This is not a complete blockchain replacement. It's a hybrid evolution. And honestly, that's probably how financial transformation happens. Gradually, carefully, incrementally. Now, this is what most people miss. The most important technological revolutions rarely happen overnight. They occur in phases. Institutions adopt what works. They reduce risk. They test systems. Then they scale. Crypto adoption inside traditional finance may follow the same path. Not a revolution, an evolution. Another historical parallel helps explain this opportunity. In 1973, banks created SWIFT. At the time, global financial messaging was fragmented and inefficient. SWIFT standardized communication. It connected institutions. It became foundational infrastructure for international finance. Today, trillions of dollars move through systems connected to SWIFT. The lesson is straightforward. Financial infrastructure often becomes extraordinarily valuable because of network effects. The more institutions that use it, the more useful it becomes. Ripple's long-term ambition appears similar in sight, not necessarily replacing every existing system, but becoming a critical layer within global financial communication and settlement. That possibility is one reason institutions continue watching Ripple closely. I want you to imagine global trade during the age of maritime empires, ladies and gentlemen. The most important assets weren't always the ships. Often they were the ports. Ports connected trade routes. Ports connected economies. Ports controlled access. Today's financial system is becoming increasingly digital, and digital finance requires digital ports, exchanges, stablecoins, liquidity providers, settlement systems, custody infrastructure. Ripple appears determined to position itself as one of those digital ports, a place where traditional finance and blockchain finance intersect. And if the vision succeeds, XRP's utility could expand significantly. Perhaps one of the most fascinating developments is the changing perception surrounding XRP. Even veteran traders who were once skeptical are increasingly acknowledging XRP's role as a transnational asset. That doesn't guarantee future price appreciation. Nothing does. But perception matters. Institutional perception matters even more because institutions allocate capital based on utility, regulation, liquidity, infrastructure, not social media narratives. And that brings us to the central takeaway. Prices reacting, systems evolving. Short-term volatility will continue. Markets will remain emotional. Headlines will come and go. But beneath the surface, Ripple is pursuing a strategy focused on infrastructure ownership, institutional integration, stablecoin expansion, and regulatory alignment. Whether that strategy ultimately succeeds remains to be seen. But one thing is becoming increasingly clear, ladies and gentlemen. The XRP story is no longer just about cryptocurrency. It's becoming a story about financial infrastructure itself. And the years ahead, that may prove to be the most important distinction of them all. If you enjoyed this analysis, be sure to subscribe, join the Wolf Pack, leave a comment below and let us know. Do you believe Ripple is building the future rails of finance, or is the market still underestimating the challenges ahead? Thank you for watching. I'll see you in the next one. Hope everyone's having a great day. I want to welcome all the new members of the Patreon, the Crypto Public Desk Monthly, all the new members of the membership channel. Always, one good tip from the pits can easily pay for your entire year subscription. If you want the deeper macro research and learn how to take advantage of all this, come and join over 560 active traders and investors inside the Patreon, the Crypto Public Desk Monthly, and take advantage of these situations. Ladies and gentlemen, do you realize the commodity boom and rush that is happening right now from the chaos? I drill into everyone here over and over and over again about being the remora. I do that because we follow what the apex predators do. We don't get cut up like sushi. We feast on the sushi. Being a financial mercenary knows how and why to take advantage of things. See, the market seasons change. Doesn't matter if it's a bull cycle, doesn't matter if it's a bear cycle. All that matters is there's movement in sectors. Once we find the sectors, we take advantage of the movement. We follow our own in-house black box systems that give us results across the markets. It's even better when the macro picture supports our algos and black box trading proprietary systems. Because at the end of the day, one of the biggest things I've been talking about, again, massive thing I've been talking about, gold has overtaken U.S. Treasuries as a world's top reserve asset. Now, I've been going back and forth about the BRICS, the unit, the East, the West, the tranche, everything. Again, there's a lot of things happening right now, but the market is looking at AI all wrong. See, this is the infrastructure nobody's seeing yet because most investors think they understand the AI revolution. I don't think they do. See, in fact, after spending weeks reviewing institutional positioning data, commodity intelligence, manufacturing surveys, supply chain reports, infrastructure forecasts, capital flow analysis, and copper market research, which I've been sharing here every day with everybody, I have come to a completely different conclusion that changed the way I look at this entire investment cycle, ladies and gentlemen. I can't believe I'm giving this away for free. This is not financial advice, just my own opinion and retains any capacity. The biggest opportunity may not be artificial intelligence, ladies and gentlemen. The biggest opportunity may be everything that artificial intelligence physically requires to exist. Write this down. This is super important. And those are two very different things. Because when most people hear the words AI revolution, they immediately think about software. They think about chatbots. They think about large language models. They think about semiconductors. They think about cloud computing. They think about productivity gains. But here's the question almost nobody's asking. What infrastructure has to be built before any of that can happen at a global scale? Nobody writes this down. This question changes everything, ladies and gentlemen, because when you begin tracing AI through the real economy, you quickly discover that AI isn't just a software story. It's an electricity story. It's a power story. It's a transmission story. It's a copper story. It's a transformation story, transformer story. And potentially it's one of the largest infrastructure stories of the next decade. Think about this. Every AI query requires electricity. Every AI model requires data centers. Every data center requires transmission infrastructure. Every transmission network requires transformers. Every transformer requires copper, constant copper, baby. Every copper mine requires capital investment. Ladies and gentlemen, we sit down every day with concession owners going over new development, new recovery, everything. See, there's a difference of talking about metals and actually physically taking them out of the ground. Remember, this isn't a competition. The only competition is against your bank account. See, we have to be right for the people that retain us, the family offices that retain us for our services. Because at the end of the day, nobody wants to miss the ship that's happening here right now. See, every mine expansion requires permitting, logistics, chemicals, labor, equipment, and years of development. See, the deeper you go into the stack, the more constrained everything becomes. And that is where things start to get very interesting because the market's obsessed with the visible winners. But history tells us the hidden winners often generate the greatest long-term returns. The names, and why I always say, pay attention to what's quiet because that's where the greatest alpha is to be had, ladies and gentlemen. You have to understand that. Most people who are super successful don't want limelights. They don't want Twitter, X. They don't. I don't use any of these things. I use this. We're not on Facebook. We're not on Instagram, or what they call Gram. We're not on any of these things. We make videos when we have time. Ladies and gentlemen, when the railroads transformed America, investors focused on the railroads. Steel producers quietly became indispensable. When automobiles transformed transportation, investors focused on car manufacturers. Every infrastructure became one of the biggest beneficiaries. See, look, when the internet exploded, investors focused on websites. The real winners included fiber networks, data centers, and infrastructure providers. Today, I think we may be witnessing the same pattern, but everyone's discussing AI outputs. Very few people are discussing AI inputs. See, we get phone calls every day from people that want offtake agreements now, and all of our inventory is spoken for the next decades to come, because people who were first movers into the space were buying things years before anyone even knew what ChatGPT and LLM AI was. I remember when the first person came to our office in Indonesia wanting metals. I don't like the computer very much, but when they showed me what they wanted metals for, I was blown away. I mean, I was very, very taken back. Now, the people who got involved then are killing it. They're just straight killing it. They're murdering it. Because, ladies and gentlemen, inputs determine scale. That's where the copper story becomes so important. See, I went over why silver and copper were moving together many, many videos before. See, most investors still think of copper as industrial metal. I increasingly think of copper as infrastructure, and that distinction matters enormously. Institutional research is now pointing towards meaningful supply challenges across global copper markets. Several major mines continue recovering more slowly than expected. Production forecasts have been revised lower. Expected supply growth has been reduced. And yet demand forecasts continue moving higher. It's going to move higher demand is going like this, supply is going like this, telephone calls are going like this. I need what you got in the ground. But there ain't nothing left because development in this sector has been very, very slow. See, higher practices and prices attract investment. Investment creates supply. Supply balances the market. But what if supply can't respond quick enough, ladies and gentlemen? That's the question that keeps getting reinforced throughout the data. New copper projects can take 10 years or longer to reach production. Permitting has become more complex. Ore grades continue declining. Environmental approaches take longer. Political risks continue increasing. Meanwhile, demand drivers are multiplying. Not one, not two, several. AI infrastructure, grid modernization, defense modernization, industrial electrification, energy security, and potentially strategic stockpiling. all competing for the exact same resources. That is not a normal commodity cycle, ladies and gentlemen. I've never seen a commodity cycle like this, and this is all I do for my existence since I'm 15 years old. This is what creates the foundation for a potential capital cycle. And if you follow markets long enough, you know what capital cycles create some of the largest opportunities to invest in. The formula is simple. Years of underinvestment create shortages. Shortages create higher prices. Higher prices. Higher prices attract capital. Give me your money. Capital eventually creates supply, but the process takes years, sometimes decades. And right now, we may be sitting near the beginning of that process rather than the end. One statistic from research actually jumped off the page. See, look, more than 60% of future copper demand growth, they come from grid and power infrastructure. Rewind this. More than 60% of future copper demand may come from grid and power infrastructure, not housing, not consumer electronics, not appliances, grid infrastructure. That one statistic completely changed the framework because suddenly AI stops being a software discussion. AI becomes a power discussion, and power discussions become infrastructure discussions, and infrastructure discussions become resource discussions, blah, 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 blah. Most investors are still thinking about the AI the same way they thought about the internet. See, I think the better analogy may be industrialization. Industrial revolutions require physical systems. Physical systems require massive capital. Massive capital creates bottlenecks, and bottlenecks create winners. Now let's go one layer deeper, because the copper story itself isn't actually the most interesting story, ladies and gentlemen. It's not. No. The bottlenecks underneath copper may even be more interesting. One of the most overlooked observations from the research involved sulfur. We gave out so many tips from the pits on sulfur, copper, oh my God, nickel. I mean, here's a big shout out to you, Wally, who's just straight killing it with the RE plays, man. I salute you, paying for your entire year subscription. You got to love that. You love the surgeon's calls. Wally, super fan. You the man, brother. Almost nobody discusses sulfur. It's so crazy. Financial television certainty doesn't discuss sulfur because it's boring. It's like watching paint dry. Elevator music. Yet sulfur and sulfuric acid are critical components of many mining operations. Industrial intelligence is beginning to suggest sulfur availability could become a constraint in certain regions. Why does that matter? Because sophisticated investing often means following second-order effects. The market sees copper, I see sulfur. The market sees AI, I see transformers. The market sees electrical equipment, I see software. That's where informational edge frequently exists. The biggest opportunities are often hidden several layers beneath the primary narrative, which brings me to transformers. If there's one bottleneck almost nobody's talking about, it's transformers. Without transformers, nothing's going to work. Nothing works. Data centers can't connect efficiently. Grid upgrades slow down. Transmission expansions become difficult to impossible. Industrial electrification becomes constrained. Transformer manufacturing capacity remains limited in many regions. Lead times remain extended. Demand continues increasing, and almost nobody's paying attention. Think about how strange that is. The market's debating trillion-dollar AI outcomes, yet one of the most critical components required to support those outcomes receives virtually no attention. None. It's like Cinderella. Nobody's paying attention. That is exactly the type of disconnected institutional investors search for. That is what we have made a reputation for. This is why people retain us, and the people that we work for do, because nobody pays attention to what's quiet. People only pay attention to when it's on the TV. By that point, all the alpha's gone. We're off looking to the next thing. Ladies and gentlemen, if you want to learn how to take advantage of all of this and what I'm talking about, come and join the Crypto Public Desk monthly inside the Patreon. One tip from the pits will pay for your entire year subscription. Join over 565 active traders and investors who want the deeper macro research, who are willing to take advantage and learn how to be a financial mercenary. It's not very hard. Ladies and gentlemen, bottlenecks frequently determine economics, not excitement, not headlines, not narratives, economics. Now let's discuss something else I found fascinating. Institutional positioning. Because capital flows often reveals information long before headlines do. The positioning data continues showing persistent interest in AI infrastructure, memory, cybersecurity, industrial automation, and related ecosystems. That persistence matters. Temporary themes attract speculative money. Structural themes attract patient capital, and what we're seeing increasingly looks structural. One particular area stands out: memory. Most investors focus exclusively on GPUs. Institutions appear to be looking at the broader stack. Memory demand matters because memory sits across virtually every layer of AI deployment. As AI scales, memory requires scale. Storage scales, networking scales, data movement scales. Memory becomes a leading indicator of broader infrastructure investment, and institutions appear to understand that. Now combine all of this together: AI infrastructure, grid modernization, defense spending, energy security, copper constraints, transformer bottlenecks, manufacturing capacity, limitations, strategic resource competition. What do you get? What do you get? You get multiple independent demand drivers colliding with the same physical infrastructure base. That convergence is incredibly important because it means that these themes are reinforcing one another. AI requires infrastructure. Defense requires infrastructure. Energy security requires infrastructure. Electrification requires infrastructure. And increasingly, they're all competing for the same resources. That is why I believe the market may still be dramatically underestimating future capital expenditure requirements. Most conversations today discuss billions. The real numbers may ultimately be measured in the trillions, ladies and gentlemen. Not because AI models are expensive, but because the physical systems required to support them are expensive, very expensive. And unlike software, they cannot be replicated instantly. They must be physically built. That is why I believe one of the most important investment questions of the next decade isn't which AI company wins. No, write what I'm about to say down. The more important question may be who controls the bottlenecks required for AI to exist. This is it, ladies and gentlemen. If you're still here at minute 27, give me a thumbs up in the comments because you get it. You got that Gucci clarity. You got that Gucci conviction. You got it all. Because I'm giving this away for free, which I can't believe. You got the theme and the narratives for free. If you want to see how we pick apart the plays and show you the levels, come and join us in the Crypto Public Desk monthly. But ladies and gentlemen, history repeatedly shows that companies controlling scarce infrastructure often become extraordinarily valuable. That is the core of being a financial mercenary and not getting cut up like sushi, feasting on the sushi, especially when demand accelerates faster than capacity. And that's exactly what's happening right now. The market continues focusing on applications. I continue finding myself focused on infrastructure. The market continues focusing on outputs. I find myself focused on inputs. The market continues focusing on software. I find myself focusing on power because every road in this research ultimately leads back to the same place: physical infrastructure. And if there's one lesson markets have taught us over the past 100 years, it's that when multiple structures converge on the same time, scarce assets, the resulting investment opportunities can be far larger than and long-lasting than almost anyone initially expects because no one's paying attention to this, ladies and gentlemen. Look, if you're going to take anything away from this, take this. AI is increasingly becoming a physical infrastructure story rather than purely a software. Okay? More than 60% of projected copper demand is expected to come from grid and power infrastructure. Copper supply growth continues underperforming. Expectations will demand drivers continue expanding. Transformer manufacturing capacity may become one of the most important hidden bottlenecks. Grid modernization appears positioned to become one of the largest capital expenditure themes of the decade. Institutional positioning continues favoring infrastructure-related themes, including memory, AI ecosystems, cybersecurity, and industrial automation. Strategic sectors such as AI, defense, electrification, energy security are increasingly competing for the same resources. The most attractive opportunities may exist deeper within the infrastructure stack, rather than among the most visible AI benefits. They're hidden under the ground. What I'm watching and what anyone retains any capacity: global copper inventories and ex-copper deficits, transformer lead times and manufacturing capacity expansions, grid infrastructure spending, commitments globally, data center electricity demand growth, institutional capital flows into infrastructure-related sectors, sulfur and sulfuric acid conditions, strategic stockpiling activity by governments, mining capacity and capital expenditure announcements, electrical equipment order backlogs, defense-related electrification spending, utility transmission expansion projects, long-duration power infrastructure investment trends, ladies and gentlemen. Why I believe this is very important? Because markets rarely misprice what everyone else can see. They misprice what everyone ignores. Why I always say pay attention to what's quiet. Today, everybody sees AI. Far fewer people see the infrastructure underneath AI. Yet infrastructure determines capacity, capacity determines scale, scale determines economic outcome. If AI, electrification, defense modernization, energy security, and grid expansion continue converging, as current data suggests, the defining investment opportunities for the next decade may not be found in the applications themselves, ladies and gentlemen. No. They may be found in the scarce resources, industrial systems, and electrical equipment, infrastructure networks, and strategic bottlenecks that make those applications possible. That is a signal I believe the market is only beginning to understand. I love you all, ladies and gentlemen. I'll see you at 7 o'clock. Remember, Gucci conviction, Gucci clarity. Don't get caught up like sushi. I'll see you on the front lines. I go over this as a tirade, and yes, I'm under the weather, and thank everybody for their well wishes. I'm getting better. But I feel right now in this game, being a financial mercenary, you don't have the luxury of stopping. No, you don't. I've built enough fly in, fly out mining camps in some of the most austere regions on the planet to understand one thing. You have to pay attention to what's quiet. You get the Gucci conviction by not looking at candles or price charts. You look at where the world is going. You look at who's fighting. That's why I'm a financial mercenary. Because finance is war at its basic blueprint. It's DNA. There's a winner and a loser. I don't ever intend to be a loser. I didn't get to where I would to be a loser. Ladies and gentlemen, I love you. I'll see you in the front lines. This content's for information and entertainment purposes only and should not be taken as financial advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Remember, the game is changing, and those who understand it first will benefit the most. Make sure you're on the right side of it. You have two choices. You can be like the crowd reacting after the move, rationalizing why they missed it, telling themselves never happen again, or you can be the one who saw behind the curtain, the one who understood the infrastructure shift, the one who positioned early, not randomly, but intentionally. Because some moments in history are loud, but the ones that change everything are quiet, right up to the moment they're not. And this is one of those moments. Do not blink because the world is distracting you with noise while XRP continues to behind the scenes and building broader digital asset landscape. Stay sharp, stay informed, accumulate knowledge. Your move now will be remembered. This is not the end of the story. It's the beginning. This opened your eyes, smash that like button, ring the bell, and leave a comment with your thoughts. Turn on notifications. Most importantly, subscribe to Crypto Public. We break down the major global banking trends shaping digital assets today, giving you context, clarity, and research you can use. Don't just watch history happen. Stay informed, stay ahead, stay in the public. I love you all. See you later.